Welcome, everyone. I'm Angelo Robles, and welcome at Family Office. And for my members of SFO Continuity, welcome. We have a special show today, Disrupting Deal Flow, a smarter approach to sourcing and vetting later stage and growth private companies. So private markets are evolving. You have to ask yourself, are you ahead of the curve? Traditional VC deal sourcing and even vetting among family offices is honestly on private deals kind of slow, fragmented, and often full of biases. AI powered, data driven investing is kind of rewriting the rules. So, we're going to really cover a special program today with a great guest who's the founder of a company called Arcanis, which is pioneering the standardization of data research and venture capital, effectively later stage and growth companies, delivering unparalleled insights into private transactions. You're going to learn effectively how self-learning AI platform like this is empowering family offices and institutional investors to often make faster, smarter, and more profitable decisions. Our special guest today is Alex Prokofyev, a seasoned professional and entrepreneur with more than 2 decades in intercontinental career spanning investment management and the telecom sector, having worked with industry giants including Nortel, Motorola, and Nokia. His experience has instilled in him the importance of reliability, predictability, and very importantly, creative problem solving. Alex grew a telecom service business from 150 million to 300 million and subsequently launched and joined ventures in telecoms automation, private equity, asset management, and venture capital. Recognizing the need for reliability in venture capital research and investing, he co-founded Arcanis with a mission to transform VC into a more transparent, data-driven, and reliable asset class. Alex, welcome to the show.
Thank you. Hello, everyone.
I'm sure everyone is doing great. So setting that stage like I did, I am a big advocate of investing in private companies. I am an advocate when I look at the history of incredible families, often investing in private companies, some they own as founders, I guess you could say, or invested into as founders, and some non-controlling, but is still very important. A lot of it comes down to having an edge. And this is to some degree a very inefficient market. If I'm investing in private companies, I'm probably not in it to get 5 or 10 or 15% returns. I likely want 25 to 30% returns or more, admittingly over time, and likely needing some diversity in my portfolio. So if you don't mind, why don't we start with talk a little bit about the biggest inefficiencies and how VCs and family offices currently source and vet deals in later stage and growth private companies?
Yeah. So major inefficiencies, which we can see from all our experience and how we speak with a lot of family offices and asset managers, we see first, there is no single standard of report of research. Everybody invent the wheel, and often this wheel is not invented in the right way. Another point is there is no completeness in sourcing. I mean, if the family office is putting together the portfolio, normally it's collected from advices from the network, and we're not speaking about looking at the complete choice of companies. So this is to some extent the network biased selection. There can be other points less important. They are not present in all of the family offices, but in some still we see quite strange investment committee where it's difficult to take decisions because there is a lot of data coming in researches and human mind is not capable to take this all. As well as in some cases, when researchers are coming from outside companies, they have all different formats and different standards. in which case it's really hard to take decisions, especially when you don't know which assumptions were factored in, unless you are capable to really go deeply inside of each research, which is not possible if you are selecting 5 companies out of 20, for example.
And in terms of the traditional VC model, would you define it almost as being broken? And maybe a part two question, the world is changing, AI and big tech technologies. How does AI powered analysis kind of change the game for more direct investors, including family offices?
I wouldn't call it broken. It has its place, and it had its place, but it looks like the time for this model, for effectiveness of this model, is getting over. What it means, the current VC model is very much dependent on guts feeling, on information asymmetry, um, on dealing with incomplete information, and all these factors, together with greed and fear, create bubbles from time to time in one sector, in 2 sectors, or in all sectors altogether, which we have seen many times over the history of VC. And every time it's explained that there is no other way because private companies do not share private information. Even SEC in the United States, SEC, was noticing out this information, this situation regarding the late stage companies and their bubbling. I think that even proposing some, introducing some standards. There was some news about that a couple of years ago. I haven't seen any advancements, but I see where the wind blows. On the other hand, AI is coming up, enabling to automate a lot of inquiries, to make available, working with a series, huge bunch of information, which was not possible with the human brain, with the 5 human brains or 10 human brains. What it means? It means that right now, using AI and machine learning technologies and big databases, actually, even a small family office, even nearest future, will be able to observe the full universe of all possible companies in the growth and late stage, and be able to see their fair values, the future of their fair value growth, and understand the risks and his own understanding of the risks. I mean, the whole picture will not be any more fragmented, and most likely the information will be shared within the community of investors, quite wider, and platforms for sharing this information. I'm not speaking about non-disclosure information. I'm speaking about public information.
Mhm.
Sharing of the public information and the research over public information, which may create consensus within private equity, about private equity companies, the investors' consensus on their fair value price, in a similar way as it is created after IPO, because what IPO gives to the company? A standard of reporting, right? Which is not present in pre-IPO time, and consensus in terms of price of equity, because there is a lot of investors and they're buying and selling on the stocks. And this is exactly what may be coming to the area of late stage first, and maybe then rolling down to the early and earlier stages. I don't believe it will get to the early stage, but to the earlier stages, like growth stage, it may come definitely.
How much of late stage investing is basically skill versus access? And is technology, which you hinted at, effectively going to help to level the playing field?
So access is very important, definitely. It doesn't play if I have a good idea of investment, but I'm number 121 in the queue to get the investment in. And but at the same time, without a good idea, on the other hand, without a good idea on where you're going to investment, to do your investment. The idea which is based on the completeness of seeing all companies in this sector, not only 2, 3, 5 companies proposed by the network, because network is in venture as it is now may be biased to some extent, and some investors quite well resist to this bias, so they manage to actually select companies rightly using their so-called unexplained AI based on wet neurons. I'm speaking about their heads, the neural network in their heads, which cannot be explained. They cannot explain how they feel it, but they call it guts, right? But not all investors are very well set with that. If we look at the performance of the whole VC industry over the past decade, we'll see that it is performing way less 15% IRR, which means that there are some good guys who can perform and some guys who cannot perform. It means that this is not reliable practice in principle. On the other hand, access. More and more, we see the information that different vehicles are getting available in the space of late stage and private equity. Vehicles like rolling funds, which kind of a replacement structure, which may replace the classical VC fund in terms of securitization. I'm speaking about this portion. And those rolling funds together, when they're packed in the securities which are transferable, for example, if this is approved, of course, by SEC, they may be more attractive and more playable in terms of access. What it means? There is such a thing, secondaries. Every time the train hits the wall with IPO or with other ways to exit, what happens? The more secondaries appear on the market. And you can see how even in 2022, where the whole VC went down, the secondaries went up. And they're going up more and more, looking at the slowdown in IPO and in SPAC, for example. And what it produces the need in the system and the whole industry for more effective ways, more effective methods for secondaries. Right now, secondary is a nightmare. I mean, it's to make a secondary deal, we needed to make a SPA contract. We need to sit down, make a KYC. There's a lot of people spending a lot of time on that. If transferable securities appears on the market and we can transfer easily from one hand to another, limited, of course, to some extent with the rules coming from the government, that can increase this market to that extent that IPOs will not be required anymore. Maybe. Still, there will be some anyway, but that can come to this point. So, to sum up, if access to secondaries will be developing seriously and quickly, importance of personal touch to or personal network to get into the deal will be less and less. But what will be more and more important, possibility or capability to select deals rightly, and not only 1 or 2 deals a year. Enough deals to diversify in order to make the 25 or 30% IRR stable. Otherwise, it's not stable if it's not well diversified. But how can you diversify if making any secondary deal now is really complex? I mean, it's a nightmare to make 5 deals a quarter, to tell the truth. But this is minimum which is needed for diversification. But new methods coming, and it's probably an unstoppable thing. The only thing which may be hindering it is government, how they'll be setting up the system. But that will be done anyway. I truly believe that.
What's the biggest mistake investors make when evaluating, in your opinion, late stage private companies?
Um, mm, there is such a term in finance which is called fair value. Fair value is kind of calculation of the future cash flow or the cost of the price of the future cash flow. Um, it does not depend on speculation. Speculation is something which is either increasing this price or decreasing this price depending on the feeling in the market. And the feeling in the market is emotional thing. We all know this is greed and fear. And when this is usual thing, when investors are somehow getting into this emotional and they switch from fair value to the speculation, that's a major mistake. It's everywhere like this, not only on private equity, but especially on private equity, because every time you feel that you're missing something, but apparently looking back um, in some nearest future, you see that that was on the top of speculation. The solution is easy, like Warren Buffett. Take the fair value and learn to calculate fair value. Um, and better, if you do not expect IPO at the end, for example, and you're not looking for IPO, you'd better make a discount to this fair value to the extent that the next buyer would also see 25% IRR at minimum. You should not sell at NPV. You should not think you will be able to sell at a fair value NPV. In this case, if you can buy the deal with the fair value, you see 25%, this is the best way. There are other ways to do it. I mean, other ways to look at that, especially in speculation way, but very often, and we have good statistics on that, we see kind of degradation in IRRs.
My next two questions you kind of brought up a couple of minutes ago, but we'll maybe take a little different perspective on it. But I think they're still important for me to bring up. In the industry of private transactions that we're talking about, are secondary transactions somewhat underutilized alpha opportunities in quote unquote VC today? Why, or perhaps why not?
Um, Secondary transactions, um, to some extent, underutilized. First of all, because there's a number of platforms facilitating secondary transactions, like EquityZen for smaller checks and other platforms, Zambatos, etc.
Mhm.
But still, the market has not consolidated yet. Of course, the government will not allow on private equity without transparency to consolidate into something like an exchange. But still, some other way will be found, definitely. And with that, the importance of secondaries in the private equity, especially late stage and growth stage, will definitely grow because companies are already very stable. So mm, trading back and forth with these companies are very demanded, and a lot of strategies appear immediately and make become feasible when this machine of buying and selling is becoming easy. But even now, in 2023, we see that there was 300 million, approximately 300 billion of total venture secondaries transactions, which is very close, actually, to the amount of investments. The amount of investments was around 400 to 600 billion. I mean, this is growing. Soon it will be bigger than the amount of original round investments.
Yes. Those are very interesting statistics. And myself, as an allocator and in SPVs, sometimes on cap table, although in my case, relatively rare, secondaries and relationships through my brokers in my network has been valuable. You could argue, are there some really bad ones out there? Yes. And not the deal, I mean the SPV. You really got to read the devil's in the details. And the fees sometimes could be, of course, just kind of ridiculous, but it's all relative to your expectations as part of your portfolio. You also mentioned this, but I think, again, it's important to bring up. How has the collapse of SPACs and big time slowdown in IPOs changed the game for later stage private markets investing?
Mm, so first of all, there is an interesting statistics we also got from the deep learning in our databases. Um, if you invest in growth in the late stage venture, in what period of time you get the maximum of IRR? In 1 year exit, 2 year exit, 3 year exit, 4 year exit, 5 years exit? The answer is 2 years.
Wow.
The maximum IRR is 2 years exit. Of course, if you receive 40% or 50% IRR in 2 years, you don't want to exit, because next year you'll still get probably 25 in average. That's why people stay there. Another point is that with IRRs here, how to say, venture capital is also looking for making more cash on cash. The metric is more on cash than on IRR. Why is that? Because if I got 50% IRR on that particular deal, do I have another alternative deal to switch over with approximately the same IRR immediately? So I got the cash. Where do I get this cash? If I don't do anything with this cash, my IRR on this cash will drop down. So this is not the right approach. And that's why people sit there in the funds. But funds are very long, sometimes 10 years. It's like a pension fund sometimes. I mean the venture funds. And it may be inefficient in that sense. So SPACs and IPOs, I wonder in some time they will become totally unimportant. Why? Because if secondaries will be serious enough, and looking at the point that 2 years is the best sitting time, not 5 years, not undefined amount of years, because you don't define when IPO will be. Probably will never be. So if secondaries move quickly, IPOs will be less and less required, and companies may stay in this case totally private, though controlled according to all the standards and things.
With deep tech, AI, and robotics commanding premium valuations, how do you kind of cut through the hype and assess real value?
Here we should be coming back to, first of all, the fair value. So there are two things which we can check, like revenue, for example. We can go to the bank and check what was the revenue. But valuation, the future valuation at which we will be able to sell, is something, kind of artificial. This is a consensus which will be then and there, and it's hard to predict this consensus between sales and buyers. In this case, only looking at fair value probably helps. Though fair value sometimes is 2 times far from the actual value, which is traded now. Why is that? That can be a sign of hype, for example. It means that in normal times, if nobody tells you that this company is doing AI or something, let's just make it blind test, right? I'm not telling you what company is doing. I'm just telling you some characteristics, what it is doing. And immediately you tell me if you are in a good state, you are not in greed or fear mode, but I'm not allowing that because I'm making blind test. You'll tell me immediately fair value. What it means? It means that in the bad conditions on the market, when emotion will be off, immediately the price will be down. Should we take a risk of that when we invest? There are family offices which really want to play in speculation risk. So they say, we know there is a speculation risk and we would like to take this risk. There are some other family offices, they say, no, we would like only to take those deals where we see that we have at least 25% at fair value, independently on speculation, which is running on top of fair value, up or below. So there are two variants, and this is two different plays. The first one, when family offices play with speculative value, we call it gambling. And the second one is a kind of Buffett's style, but it's more moderate and sometimes less effective in terms of IRR, but more stable. Seriously more stable. If in 10 years you will see the results of first and second type of investors, you will see definitely a serious difference. The second type will get their 25% IRR definitely.
And Alex, why do you believe that AI-driven analysis is the future of effectively VC or private company investing?
There is no other way. So it's the future of any technology or any industry right now. It's like a new electricity. So you cannot avoid that. In those who will try to do in the old way will be lagging behind very quickly. AI allows to very quickly extract a lot of and review a lot of information. That information which your analysts would never even able to see or never have time to see, and it allows to implement new models quickly, and it allows to improve these models with itself. Right now, the development of AI is not really strong yet, so you cannot take a general LLM and ask a serious question. It will either start hallucinating or making different responses in different times when you ask it. But if even now, if you break your big problem into smaller problems and use LLMs and automation in order to get an automated result, in this case, you can achieve the power of 1,000 men in research, for example, within 1 hour. This is an unbeatable thing, and it will be pushing all industries, not only this one. So no way to be lagging behind.
100%. How does Arcanis process and verify data in inherently a very opaque and fragmented private market?
That's true. The private markets data is fragmented and lots of data missing. So what's happening? Arcanis has a serious system to collect all possible public data and cross-verify it with the sources and label this data before feeding this data into the models. And models, we developed plenty of models which behave, I would say it this way, they behave as separately living creatures. So they know what they want. They go into this labeled data lake and they try to feed themselves there. If they find enough data, they start producing some result and they start to cooperate with other models and cross-check each other. And through this, they develop a clear path from the data which we've got collected to the outcome. And this outcome is, so this whole path to the outcome is a proof that from this data you can only have only this outcome. And this way we use AI quite extremely, but at the end there is no unexplainable AI. AI helps us to build the proof that this is a result based on this data. Sometimes, though, there is not enough data to make a very precise result. In this case, we have a range of results because we do not take, do not allow any human to make any bias into the system, and in case of there is some instability of incoming signal, we've translated as instability of outgoing forecast, and this is clearly seen. But if you throw there your NDA data, so we don't have your NDA data. We've got the public information. We provide you our research. Our research is not a research on paper. It's an instrument in which is live, it's working, and you can actually interact with it. You can throw your data into that, which you know, but others don't know. It will
Yes.
process that data and make a more precise result for you in particular.
You mentioned before, to some degree, doing more with less. The statement I say is not many Spartans are needed to win battles, assuming, again, they're the right people trained with the right resources. So, how does your proprietary technology allow investors to conduct effectively diligence at scale? That's the key, at scale and speed without sacrificing accuracy.
So what we've put together as a technology. So first of all, we have not done a proprietary AI. We use non-proprietary standard LLMs, standard AIs, and we are building the application on top of that. So it's too early to train AI here in this area because not enough data. Nobody has enough data. At least we don't see. So when we put together this system of cascaded AIs, each making simple job, and all this is run in bulk on multiple hundreds machines in parallel. This is classical IT technologies, nothing special. We can actually research, let's say, 20, 50 companies at the same time. And we are running very quickly to be able to research every month all companies, because when we achieve the power of totally automated and totally precise, with the proof, not just magic black box, which is answering, provide some information. No, research with the total proof for all companies every month. And this is not very far. I mean, probably half a year in a year, we will have this product. It means that the necessity of human in this area is not anymore needed. So what human will be doing, they will get to the higher rank of dealing with already pre-cooked, prefabricated research, where it is possible to put your understanding of future reality, and then your research will be different from somebody else's research, because you have your view, I have my view, different views, same research tool, but different views produce different result. And this is normal. But only one thing which is good here: we do not make mistakes in simple things, because these simple things will be handled by machine, and machine can do all companies in a row. There is not many companies in growth and late stage, 9,000 maybe, of which probably only half life. That's all. I mean, it's not a big thing for these type of big systems.
How does Arcanis complement or compare to like a Bloomberg terminal or PitchBook? Is that applicable in what we're talking about in later stage and growth private companies?
So right now, both Bloomberg and PitchBook, they unveil certain AI instruments which allow to make basic work with the information which is already there. Nothing stops them from making similar thing to what we do, because what we do is we put together serious number of models, serious calculations, and let AI to bundle it together. Probably to some extent, we are ahead for a year or two because we started 2 years ago. But definitely, some of them will be there. PitchBook is still looking at the lower layer data. So they're not looking at making the full research. When we're speaking about full research, it means that if I hire a super analyst and I give him infinite amount of money and time, what best research he can make from this data? We would call it ultimate research. PitchBook and Bloomberg, they don't go into ultimate research. Bloomberg can resell to some extent some ultimate researches of other analysts. Sometimes there'll be researches from machines as well. Will Bloomberg make a machine? I doubt they'll make machine. Maybe they'll buy machine like ours or somebody else.
And maybe turning some attention to market trends and investment strategy, are late stage private companies overvalued now? Or is actually this an overlooked golden age for private investing?
Depending on the sector. For example, trained AIs, as we can see in our researches, they are way above fair value. So I would say they are overvalued. But the AI applications, this is where the companies which are not training their own AI, but they use existing AIs in order to penetrate into those industries where they will create serious difference, like SAP, like 20 years ago. That was a total change, ERPs, etc. Right now, same change is coming with AIs. Do they develop new AIs? No, they just develop new applications in certain niches, and these things will be infinite, huge, and growing. And right now, not in all the niches we see super hype. Of course, with every time we hear the word AI, immediately there is super hype, but not in all niches. We need to be watching them quite attentively, and there is a lot of good companies below fair value.
A question that I kind of began with, I'm going to ask a little bit more directly and succinctly. How will AI disrupt venture capital, and potentially could it make traditional VCs obsolete?
The short answer is yes. It will kill us all. But before, so VC itself consists of number of functions, which were traditionally bound together to such extent that you don't even see the differences between these functions. So one function is to collect LPs. Another function is to source. Another function is to securitize in one way or another, maybe Cayman fund or something, right? Another function is to make research, etc. But now these functions are better done by separate companies than in a single office, which is good for all. In which case, it may happen. I'm not telling that that will happen, but it may happen that GPs will become a separate function, a GP. The securitization will be platforms, and you don't need to make your own every time. Research will be bought from companies like ours, like subscription, as it will be standardized, and then you can really trust it, because this is not a production invention of the wheel made by an analyst, cheap analyst you hired. It will be a standardized something created by the machine. And then investment committee will be getting automated as well. And representation on investment committee will be automated to the extent that AIs from investors will be present there, not investors themselves, because the amount of information to take into account is too much for human brain if we speak about serious decision, not about kind of pretending that we do understand it all. Serious things, it means that probably 3 to 5 different functions it may break up. And yeah.
Oh, please.
Last thing, venture funds now, in terms of securitization, is where you subscribe to the fund, and then you follow calls um, over 3 years of fund implementation. Then you wait for the cash back. Quite an unpredictable cash flow, and a lot of complaints from asset managers, and that's to that regard. Because of unpredictability of cash flow, nobody in the future maybe can afford that. In which case, I see that we have seen already examples of rolling funds where a venture fund or whoever, I don't know how to call this new creature, will be creating a fund every half a year, for example, buying 5 or 10 companies into each. Same strategy, next fund is totally separate from the first one. This enables transferring of shares, secondaries for the fund, does not stop investors from not following next calls, let's say. So it's kind of subscription, but not same difficult like venture funds. So that thing is also coming. So everybody wants faster cash flows. 10 years, too much.
A little bit similar to the question prior to the last one, actually, but there's nuances to it. Are private markets still, maybe that's the key word, still inefficient enough to generate alpha, or has the edge disappeared with increased competition?
They are very well inefficient right now. There is a lot to do here, but this delta, so alpha, we need to measure alpha against something, S&P 500, for example. Definitely, there is a lot of inefficiencies, but they will be quickly covered with solutions with AI and new funds. And if we just for a little second step back from watching particular VC firms and the drama in VC, and from the bird's view, we'll see that this is all just about capital trying to get into the companies in the different ways. This is kind of a river floating into the ocean to some extent. And this river, if it has some problem in the middle, it will find the way around. And we see that right now this is happening, and it happens because AI happened. Therefore, we'll see totally different ways of doing business here.
Yes. What I'd like to do, your team sent me a wonderful PowerPoint. It's easy on Zoom, on StreamYard. I'm going to see if I could pull it up. And I think 70 to 80% of it we kind of covered relative to my questions, but we'll maybe highlight what could be some important parts. So hopefully you'll be able to see it as well. How is that? Alex, could you see that?
Yep, I can see that.
Okay, now again, I could control like that moving forward. Would you like me to go back and explain anything on the prior slide, or we're good here? Now, this is going to be hard for people to see watching it on video, to be honest with you. But if you wanted to point out a key point of a couple of slides we could go through, that might be helpful.
Yes, but at the same time, I didn't want to step back from the visionary perspective. So let's take these slides on a high level.
Yes.
So first of all, take it as probably as a joke, but what in Arcanis we do, we kind of put together the information for decision makers, which is ready to go to make a decision. And right now, Arcanis is making it for human decision makers. But we are already preparing ourselves to make it for non-human decision makers. So just let's bear that in mind. Very soon, decision makers on the business side, I mean, on the investor sides, will also not be human. So this research is being prepared right now for human, but in the future, we are already prepared to make it not for human. Human view of research, you can see it on these slides. It's a one page eye catcher, easy to understand, fair value, and the proof, and the risks, etc., which allows to take a decision immediately without comparing companies easily one to another, in order to understand how to build a portfolio which will definitely make, with the minimum risk, the 25% and plus IRR. But in the future, we have prepared an API. It will just go directly to the investment firm, and its AI will be deciding that, and human will be looking only high-level picture of what's happening with the portfolio, or what may happen. So in these slides, you see the depth of the technology stack which we used, because we started 2 years ago, straightforward from making the enterprise solution, so which is scalable enough and self-testing enough, and works on multiple thousands, or not thousands, hundreds of parallel machines, etc. But if you go to some other slide, I probably tell you something more. So this is an example of one pager summarizing the whole report. If you print the whole report, which is corresponding to this page, that will be 200 pages.
Wow.
Normally, really good report is about 200, 150, 200 pages. And I was always laughing at investment committees when a number of people come in there with, let's say, 5 to 10 companies. They all pretend they have read them all and remember what is written there. Not always it works. You see, human is not enough here. And that's why we break the report into the outcome. This is outcome. And it is playable outcome. I mean, it's not fixed. You can, depending on your beliefs, your picture will be different from mine, because this is instrument. And the rest 150 pages is the proof, human readable, auditable proof that this is right, so that you know how this is built. It's not a secret how this is built. So this is the only way right now. And when this standard will establish itself, and we are pushing for making a standard that of doing things in this area, when the standard will establish itself, it will be available to everyone as an online system or subscription. In one way or another, even if we don't succeed with that, somebody else will do that, because this is obvious idea. And a lot of asset managers are asking us. Last thing I would add to here, they ask, Alex, why, for example, for Revolut in the world, every month analysts prepare around 1,000 reports about the same company. 1,000 reports. What a waste of effort. Why don't we have a single site where these analysts join efforts in order to improve or make one single report, maybe as an instrument which allows different views, but to make a single report which reflects and follows the company? Does it want it, this following? This is based on public information. Or does it not want to follow? But that should be independent and watcher after the company. And this is where we are going, because this is demanded by the market. Preparing thousands of reports on each company, it's non-effective in the world.
I mean, so the current model, at least for someone like me, is I have several banking and relationships with SPV providers that here's what I'm kind of looking for, and they show me sometimes daily, weekly, monthly, depending on cash flow availability and my interest. But obviously, they're looking to pitch a deal. Of course, it's always great from their perspective. This allows me to utilize the service to do more of my own diligence and very possibly much more of my own sourcing, so I could be more proactive with my relationships that may be the broker in between them. How much could something like this, just getting down to the brass tacks as an allocator, and if I'm going to be looking at 10, 15, 20, 30 deals a year, how much is this going to cost me?
Way less than these reports cost now, and with the way high availability. So it means that you can have 100 reports a month easily. Whereas a normal team of, let's say, 5 analysts, which you probably pay from 100 to 150 K per year, would generate probably 30 reports a year. I mean, big reports, the final thick reports. Here, of course, when it is automated, the price will be dropping down with the development of technology. And even right now, it is already a fraction of that. And you're totally right. If you have the system or subscription which allows you to see, based on all available current data, the fair value of this company in the nearest future, next 5-10 years, that reality can be shared between buyer and seller, and this allows them to have a basis for a fair trade, not the speculation trade. And in this case, you can even factor in certain risks, because this is this type of tool, this type of instrument allows you to actually view any possible scenarios right from this front page. It means that when you are, for example, in your example, you are discussing about the buying price from a broker on a particular secondary, you show him the screen and you play these scenarios, and you show that for your 25% IRR, you cannot afford the price higher than this. And this is obviously seen right on this page. If he shares the same information, that will be easier to agree.
I mean, that's fantastic. The ability to source through the database, the ability to be more proactive as well as reactive where need be, but be able to do the diligence quickly without, again, like we discussed, and I'm going back to our old format. Here we are. Alex, I think what you've built is fantastic. I think
Thank you.
family offices just need to understand more about it. This is game changing. And the world of even VC and fund investing, secondaries, the interaction as a family office with them, and really everything, primarily due to AI driven resources and tools, is changing so rapidly before our eyes. To not want to maintain an edge, to mitigate our risk, to get the returns that we want to get as private investors. And some of the incredible information that you shared today, I think, is very, very valuable. Alex, by the way, his last name is Prokofyev, a co-founder and CEO of Arcanis, spelled Arcanis. Alex, for those that are interested, how could they learn more? Whether they're interested in the actual service, whether they're potentially interested in looking at it from a perhaps investing or other opportunity as you look to grow and expand, what are ways that they could reach out? Now, they could always come to me, and I'm more than happy to pass it on. But if you wanted to share any more open or public info, is there a website? What's the URL? How could they reach you? I'll leave the floor to you.
Yeah. So the website is there. It is arcaniscapital.com. Same way, info@arcaniscapital.com, or my email, AP, like Alex Prokofyev, first letters, at arcaniscapital.com. Always available. So, but if somebody decide to go through Angelo, I will be really delighted.
Of course. So again, that's arcaniscapital.com. There's info for email, general info@arcaniscapital.com, and your initials, I guess, AP as in Peter, at arcaniscapital.com. More specifically for my members, although sometimes I'm too nice to others, again, I've been experimenting with it. It's been great. I highly recommend that you learn more about it. Go to the website and reach out to me, and I'm happy to make an introduction to the team. so you all could learn more about the opportunities. This is a game in this industry where the slightest edge makes a big difference. Alex said that the markets within private companies are still wickedly inefficient. I completely concur. Although I'm a very active public markets investor, and sure, we all have done great the last 2 years. And of course, because I'm better than most, I think I'm going to be above average moving forward, even though that's a wickedly so called efficient market. The reality is, I just don't know. There are some incredible entrepreneurs, some wicked inefficiencies in the private markets, and where if you're willing to be a little bit more patient, tremendous opportunities still abound. I know I'm allocated to some, and I'm very optimistic with some of the returns, at least internally over the last year or two. But having a tool like this, I wish I had this last month, 6 months ago, definitely a year or two ago. So this does make you do more with less for a relatively cost-effective platform. We didn't really get too much into that, but trust me, I think it's very effective relative to having, like he said, what a team of analysts and others, or relying on that your broker or bank is always going to put only the most incredible deals in front of you. Like you're foolish if that's what you think. That's just not a reality of how the world works. So I'm very excited about what you're doing. I highly encourage families, investors, and family offices to learn more, to have that edge, to see how this industry and this world is changing and how the AI driven resources and tools. But there's so many of them. And how do you condense the resources into that beautiful one pager that I showed many of you before? Which I get it in a video is going to be a little hard to get the nuances of it. But Alex or his team will give you that presentation. You can absorb it more and then see the value, which is easier to digest than watching it on a mediocre resolution on a screen, probably even on your phone, where you have no chance of viewing what we showed a couple of minutes ago. It is powerful. I highly recommend you have an opportunity to reach out. And again, feel free to, especially my members, to use me as a conduit. And then I just make the direct intro to Alex and his team, and happy to do so. So everyone, I'm Angelo Robles, the founder of SFO Continuity, a private consortium, a private intelligence for single family offices that want to be committed members. Also the founder of That Family Office, my primary YouTube platform where I look to share publicly information, usually after my members had first access and the opportunity to interact with my guest. And they get it, no edits. There are times when simply things need to be edited a lot if they even make it up to something like YouTube. So henceforth, nothing beats being live and interactive in the very moment and having opportunities that I come across as an allocator that I want to share with you, like this example here, which helps me, I hope, do my job better and become a better investor. I want to share with all of you as well. So I hope you found value in it. Alex, any parting comments?
We are all right now at the seriously raising wave, and to ride the wave or be below the wave is our choice. And from my point of view, it's a great pleasure to live in a time of change. This changes all, and changes for good things, not for bad things. So let's focus on that. And my pleasure, Angelo, to be present with you here and to discuss these important topics in this particular moment. Thank you very much.
My pleasure. Thank you, everyone. I hope you enjoyed it and look forward to the next time. Everyone, I'm Angelo Robles. Thank you.